Warning: any copying, distribution, or public performance of this audio is strictly prohibited and may subject the offender to civil and severe criminal penalties. The $1 Million Roundtable does not guarantee the accuracy of tax and legal matters and is not liable for error or omission. You are urged to check with tax and legal professionals in your state, province, or country. The MDRT also suggests you consult local insurance and security regulations and your company's compliance department pertaining to the use of any new sales material with clients. Copyright 2011 $1 Million Roundtable. Increasing the Efficiency of Retirement Income. Thomas F. Love.
My name is Gene Mahn, and I'll be introducing today's session, Increasing the Efficiency of Retirement Income, presented by Thomas F. Love. Before we begin, please note the location of the exit doors here and back. If you need to leave the session for any reason, please use the exit door to the rear. This is a 60-minute presentation, and instead of questions and answers afterwards, Tom is going to do a real-life case, which I think will probably answer a lot of the questions that you may have. Afterwards, he'll be available outside the back of the room at the end of the session to answer any Q&A that you might have. In this session, Tom Love addresses the three types of retirement income: tax increasing, tax neutral, and tax reducing. When developing a retirement plan, you'll be equipped to address taxes, their impact on cash flow, and the benefits of cash value life insurance. Tom has worked with agents all over the United States, having helped them increase production by several times. He has been in the life insurance business for more than 30 years. He's a 4-year MDRT member with 1 court of the table qualification. Please welcome Tom Love.
Good afternoon. Test. Perfect. Thank you for coming. What an honor and a privilege it is to be here. Before I begin, though, there is someone that I would like to personally thank for me being here. It was May 24th of last year that I was speaking to a group of people in California, and the past president of the $1 Million Roundtable heard me speak, and it's with his persistence that I'm here today. And Gene, I want to thank you. Appreciate it. You, on the other hand, have no idea what you're clapping for. You haven't heard this yet. If at the end of this 1 hour you like what you hear, please be sure to thank Gene. Before we begin, I'd like to have a show of hands, if I may, and please keep your hands raised. 40 years in the business or more. Wow, my head is off to you. Thank you. Keep your hands raised. 30. 20. 15. So now we should all have pretty much all of our hands raised. Okay, you may set them down. 15 years or less. This conversation is going to be a little bit more unique for you to understand. For those people that have been in for business 20 years or longer, I think are going to grab this a little bit faster. I've got 1 hour to share with you today, and this is what I'd like to do. I'd like to give you a very brief background as to how this presentation came to be. I'd like to share with you the actual presentation. It is 38 minutes long. That's it. I then want to give you an example of how everyone in this room can get on the phone and talk to their client. I'll share with you the language that it's going to take to get the appointment. And then I'm going to show you how, on a family that earns $110,000 a year, maximizing one 401k plan, has an average debt load, and has a 15-year mortgage, how you can write a $28,200 premium when you leave here. I'm then going to show you how to... Thank you. I wasn't expecting an applause there. That's awesome. Yeah, but again, thank you, but you haven't heard it yet. Then, if we've got time, I'm going to open it up for questions and answers. I do an awful lot of driving, and one of the things I do when I drive is I realize that where I am today I cannot affect. But what I can do is realize what today will do and put myself in front of the effect. If this will cause something, Where can I position myself 2, 3, 5, 10 years down the road so that I can take advantage of what will happen with where we are? When I got into this business 30 some odd years ago, I was told as a young man that if I could survive this business long enough, I would be witnessing the largest transfer of wealth this country's ever seen. My task at hand would be, what possible story could you be sharing with people so that when the demographic baby boom is retiring, they're going to want to single you out? This conversation is about the efficient and effective way of spending your wealth while you are alive. That's it. And when I go around the country, it still amazes me how many financial advisors and financial coaches are talking about wealth accumulation. How to turn one bag of money into two. January 1st of 2008, something happened that lasted 2 weeks in the media and gone. Something happened January 1st of this year that lasted less than 1 hour and gone. To me, it is the most important events that have happened probably in our lifetime. In January 1st of 2008, the first baby boom qualified for Social Security. Didn't file, qualified. January 1st of this year, the first baby boomer filed for Medicare. Now, people, remember the baby boom demographic. Remember, these are the people who decided where hospitals would be built, where schools would be built, where subdivisions would be built. They're now going to no longer be a contributor of savings. They're going to be a spender of savings. That dynamic has never been tested before in the market. Never. Think about this for a minute. If you've ever seen a portfolio manager for a mutual fund company work, it is fascinating. Yes, they have 9 monitors on their screen or on their desk. One is redemptions. So think about this. We're going to be in an up market for the right reasons, and the portfolio manager is going to be in the stocks that he or she wants to buy. And at 3:50 p.m., they look over at that redemption monitor, and they have to sell stocks they love that are doing really well, not because the market's bad, not because the stocks that are in the portfolio are bad. Jane and Bob need their mortgage payment. You think the market's been tough over the last 12 years? Wait till that dynamic hits. It's going to be tough. It is going to be tough. About 4 or 5 years ago, I heard a gentleman that has changed my life. And I'm going to give him credit. It's Don Blanton. So some of the stuff that you're going to see here is a little bit of Circle of Wealth. Some of it is Infinite Banking. Some of it is Wealth and Wisdom. Some of it's Leap. On and on and on and on. What I've done is I've put together a 38-minute presentation and talks about efficient and effective ways of spending wealth. That's it. Let's go ahead and get... Cheese. Let's go ahead and get started. By the way, technology is phenomenal. When I was setting up here at noon today, I opened my computer, and Delta Airlines had smashed my computer. So when I went to look at the computer screen, it's nothing but a spider web. You will watch me looking at that because I have no screen on my laptop. Thank gosh we were able to get the software out of the computer. You know, we can only plan for so much. Let's go ahead and get started then. 38 minutes. That circle represents everything that you've made in your life and everything you're going to make for the rest of your life. It is your circle of wealth. You have one, I have one, everyone in this room has one. Some are larger than others, but the objective is exactly the same. I want to make that circle as large as I can in the shortest period of time. That circle, however, is broken down into 3 very distinct, separate areas. And the first area of wealth that I know you're familiar with is called accumulated wealth. I call it stuff. I call it statement wealth. Every January 2nd, you are reaffirmed through the United States Postal Service exactly how much money you have in your IRA, your 401k, your 403b, your 457, your Simple, your SEP, your SARSEP, your pension, your E-I-E-I-O. If you do a net worth statement for the bank, you have to reaffirm your accumulated wealth with them. And most financial advisors, not coaches, but financial advisors will both start and stop their effort to do business with you right there. And they'll say things like this: give me your money. All of it. I'm good. I'm entitled to all of it. I'm going to try and put you in investments that's going to get you a much better rate of return. I can't guarantee it, but I'm going to try. But here's what I do guarantee. I get paid a fat commission. Chances are I drive a nicer car than you, and you end up with another statement reaffirming the wealth you had 2 weeks before we met. Now, when I speak to clients, they laugh at that part. Because believe it or not, that's what they think we do. And that's all we do. I make light of this. As a matter of fact, I try to dismiss this as much as I can. It is a piece of the puzzle. It is not the solution to the puzzle. There's 2 other parts to that circle that are blank. And if you're like most of my clients, you'll be very well aware of one and oblivious to the other. And the one that you're not familiar with is where I want to spend the rest of my time with. The area of wealth that I know you're familiar with is called lifestyle wealth. When I talk about lifestyle wealth, I talk about 2 things: needs versus wants. And if you understand the psychological process involved with purchasing something you need versus the psychological process involved with purchasing something you want, there is a huge difference. If I told you in this room that I do not sell anything, some of you will believe me, most of you would not. All I do is create environments conducive for people to write big, big checks for their reason, not mine. But when we go through needs versus wants, if you understand the psychological thought process involved in something you need, you hate it. You'll research it till you're blue in the face, until you make sure you don't spend a dime more than you have to. You'll cringe at the thought of writing the check, and you'll despise the fact that the bill might be due again next year. Isn't that a fun way to sell life insurance? On a need basis? And I'm not knocking it, I'm just telling you psychologically that's what you're up against. Now, let's talk about things that you want. I have 9 cars, an airplane. If I see something I want, I go buy it. There's a different psychological thought process involved in that. I want to create an environment conducive for people to want to do this. That's what we're going to talk about. There's a third of the circle here, though, that's blank. There's nothing in it, and it's blank on purpose. The entities that control that part of the circle have truly a vested interest to make sure you never know what it is. Because if you knew what it was, you'd change your habits. If you changed your habits, they wouldn't get paid anymore. They'll get angry. And you know what? They've done such a good job of marketing because it's little bits of interest. It's little bits of fees. It's little bits of taxes. And we've become so accustomed to it, who cares? This is called transferred wealth. This is money that you are giving away unknowingly and unnecessarily every single day and don't even acknowledge it. You don't even know what's going on. Now, there's 36 examples of things that you and I do on a daily basis that says goodbye to our money. 36. It's not so much the money that leaves my checkbook. It's the income it could have earned had I been able to keep it for life. That's what bothers me. But again, it's little bits of money, so who cares? It's just little bits of interest, so who cares? Well, I do. Because here's what I want to try to do. I want to try to identify some of these 36 ways. And I want to plug the holes. I want to capture that wealth that you were given away unknowingly and unnecessarily and add it back to your accumulated wealth. So you can go buy more stuff, things that you want. That's the whole purpose. I'm only going to go over 2 examples because I think I make myself clear in just 2, even though there's 36. And the first is a car. Show of hands, who has a car? See, what power we have up here. Okay, raise your hand again. Look at this. This is... How many people are financing that car? Oh, don't raise your hand. You'll be singled out and gone, ooh. 0% financing, low-cost financing, 2 years same as cash. All the crap we've been told to try and get us to believe they've got our best interest at heart. Let's assume a 30-year-old starts buying automobiles. And we start long before the age of 30. We sign up for the $300 a month car payment for 48 coupons. What happens at the end of the 47th month? That's right. You know what? You look at your sweetheart and say, gosh, we've budgeted this. We've already put $300 a month aside. Let's trade it in. Think about this. If you would have kept those cars, do you know what they'd be worth today? But that's not what we did. We traded them all in because we needed to get our car payment down to $300 a month. And we do this over and over and over again. And we do this over and over again until the age of 65. Let's take a look at what happens when we're 65 years old. You have one car. One. That today is worth less, not worthless, worth less than what you paid for it. You have 35 years of canceled checks and one automobile. If you were trying to earn 8% return on your accumulated wealth, but you've given up the 8% on your own money because you've been making car payments, do you know how much money it costs to drive one car? $688,000. Now, people, we all know husbands and wives that are driving rented or financed cars to go to separate work locations to sign up for something neat at work called a 401k, hopefully to have $1 million at retirement, spending $1.3 million to get it. Is that good financial decisions? But it's only 0% interest. It's just this short-term financing. $688,000. One of the things we're going to talk about with this concept is we're going to show you how you can turn yourself into your own bank. You will never again have to borrow commercially to fund anything you want, whether it's another automobile, whether it's sending your kid to college, whether it's an addition on your home, whether it's whatever you want. You'll never have to borrow from anybody else. Does that sound like something any of your clients you think would want to hear about? Absolutely. Absolutely. Here's the second example. You need to borrow $10,000. Now let me set the stage here. This is not for a child's emergency surgery. Everybody in the room would borrow from the devil to do that. I'm just simply saying you've got a kid who's getting ready to go to college. You need to put him in a somewhat decent car. You need a roof on your house. You need a furnace in the basement. You need to borrow $10,000. And when I use the word borrow, the first thing most people think about is the bank. So let's go back to this glorious time of September of 2008. Remember how much fun that was? Lehman Brothers had just declared bankruptcy. Merrill Lynch was on the verge. Most financial institutions were sick. T. Boone Pickens goes on television and says, I'm a billionaire and I can't get a loan. I cannot imagine what the average consumer is trying to do. You simply need to borrow 10 grand. Banks tell you no. Now, you do have friends and relatives, but they have caller ID. I know why you're calling. I would lend you $10,000. In a heartbeat, I will. Because listen to the terms. But because it's a loan even from me, there's two things you're going to want to know about my loan even before you'll take my generosity. What would that be? Interest and terms. But listen to my answer. You know what? I'm having my best year ever. This is a phenomenal year for me. And I have no idea what I need to charge you. But don't worry about that right now. Just take the check and cash it. I know you need the money. And I'm honored that you have asked me to help you. So please take the check, cash it, and spend it. Now, there will be a point in time that I'm going to want my money back. That could be 10, 15, 20 years from now. At that time, I'm going to knock on your door at 4 in the morning. I'm going to tell you retroactive to the day that I gave you the loan, the interest rate I want to charge you, and the terms at which I expect to be repaid. Would you take my loan? Does anybody in this room have a 401k plan? You're already doing this. Let me share with you what I mean by this. From the 4-year period of time, 1988 through 1991, the highest marginal tax bracket was only 28%. Yet in that 4-year period of time, we had doctors and lawyers who were putting $1 million in their pension plans at the advice of their professional advisors so they could enjoy a $280,000 loan from the government. Say what? A $280,000 loan from the government. That is not a refund, people. It is a loan. An interest deduction is a refund. A 401k contribution is a postponement. Now, fast forward to today. 23 years later, the doctor wants to see his contribution only, not a dime of interest. He wants his cost basis back. he'll need to stroke a check for $350. And if he waits until January 1st of the year 2013, he will owe $396,000. This, ladies and gentlemen, is a $116,000 oops. I made the joke one time of telling the CPA I was giving this presentation to. I said, in our business, that's a $116,000 E&O claim. And I just kind of brushed it off. I had no idea the impact I had on this guy. None. He sent an email to his senior partners. We, the firm, have created a problem that didn't exist until our advice put them in this problem. You've got to hear Tom's presentation. Now, who's heard of the scalding frog theory? Show of hands. Fascinating. You take a bullfrog and throw him in a pot of hot water, boiling. The abrupt change of temperature will be enough for him to realize he shouldn't be there. He will kick himself out. He will burn, but he will survive. You take that same bullfrog and put him in a pot of cold water, set him on the stove, turn it on high. The gradual change of temperature will never be enough for him to realize he shouldn't be there. He will become so lethargic you've killed him. You see, if we go from 35 to 39.6 to 42 to 58, do you understand what the highest, or not the highest, the average marginal tax bracket has been since 1926? 60%. It's just been the last 20 years that we've enjoyed low income tax rates. Now, I don't know if you remember this or not, but when Hillary Clinton was leading Obama in the polls, first time ever I can remember in a presidential election, the presidential candidate told you up front how badly they wanted to hurt the wealthy in this country. She did not think her husband's bills, 39.6, was high enough. She said up front, I think it should be 50. Now, see, that's a quantifiable calculation I can do. I was on the phone immediately to my clients saying, listen, if Hillary's tax law goes into effect on January 1st, December 31st, you're getting out. Even in a 35% tax bracket, you'll pay the tax and the penalty, which is 45. It's still less than 50. You're going to get out. But that's not what they're going to do. 35 to 39.6 to 42 to 48 to 51. And if they gradually turn up the heat long enough, you'll not know that you've been cooked. And it will happen. Now, to put this into perspective, if that bar graph represented how much money you have in your qualified retirement plans, let's assume it's $1 million. Here's where I have fun. How much of that million is yours? All of it. Oh, I'm sorry, I asked the question wrong. How much of that is yours? Tom, my name is on the statement. See, it says 1 million, and this is my name. I apologize, I asked the question wrong. How much of that is the IRS's? You know, we could sit here until we're blue in the face. You know the only answer you can give me? I don't know. Now, this is going to play a very integral part here in just a minute. I don't know. And you don't know why you don't know? Here, I'll tell you why. Qualified retirement plans do two things. We're very well aware of one, but we seem to be oblivious to the other. We understand that it postpones the tax. But what we don't realize is it postpones the tax calculation. Now, when I speak to CPA groups, it amazes me how many don't understand that $1 million example. The doctor did not put in $1 million in his qualified retirement plan. How much did he put in? $720. The IRS gave you $280 on loan. The partnership, cha-ching, began that day. Now, how can I prove that beyond a shadow of a doubt he only put in $720? Sell it. Redeem it the next day. Is the doctor ever going to see that $1 million? Never. Never. There are 3 types of retirement plans. Now listen, I'm all for saving money. I just don't think a qualified retirement plan for people who aspire to be wealthy or who are wealthy should have a dime in a qualified retirement plan. If I had an application in my briefcase that was magical, Magical. All you had to do was sign it. And in 24 hours, your money doubles. That's right. Your $1 million becomes $2 million overnight. No commissions, no market value adjustments. You simply have to be one day older. Chances are you'd buy that. And you would fall prey to what I refer to as the ever-increasing income tax liability plan. I want you to stop for just a minute, and I'm going to just twist your brain. Why does the IRS tell us not to keep track of our cost basis in qualified retirement plans? Anybody? It doesn't matter is their answer. Because whatever you touch out of your qualified retirement plan is 100% taxable. I have a different theory. I don't think they want you to know how little they've contributed to your plan. What amazes me is for the people who are wealthy in this country, they're only going to get wealthier unless by accident something happens. Most will continue their stream of good fortune. When you have one bag of money that becomes two bags of money, does the IRS's cost basis change any? None. Zero. And as a matter of fact, the IRS says you only have to keep track of your tax returns for just a few years. If you went back and audited every one of your clients' income tax returns from the beginning, remember they had 3 kids at one time, 3 in college at the same time, they had mortgage interest, their effective marginal tax bracket was 10. And you maximized your 401k contribution. You struck oil in any fashion you wish to fill that statement with, whether it's a success in business or you literally struck oil. You have become successful now. What happens to your tax bracket? You may go from 35 to 31. You may go from 31 to 28, but you're not going to be in a 10. Listen, I get it. For the people in the audience who sell 401k plans, 99% of the people that sign up ought to be there. I understand that. They're working, they're making more money than they are when they're going to retire. I get that. The business owner shouldn't be in the plan. Shouldn't be in the plan. Now, if you're not 59 years old, you are eligible for what I refer to as the tax-neutral plan. This is Internal Revenue Code Section 72T, and it basically says this: I don't care how old you are, you can take money out of an IRA and pay no penalty, as long as you follow one of 3 formulas. And you can choose the one that's most advantageous to you even. But once you start, you cannot stop. You have to continue to the age of 59 and a half or 5 years, whichever is longer. The idea behind this is to keep the account from doubling inside the umbrella of a qualified retirement plan and take the taxes out in a tax bracket you can quantify. Take little bits of money out. The rate is 2.2 to 4.4%. It's published every month by the IRS. It's a moving factor. The older you are, the higher the return, or the higher the amount you can pull. So if you're 55 years old, you can take out roughly 4% of that million. You can pull out 50. You want me to pull what out? Why would I want to voluntarily take money out of it? I understand. This is a choice. You don't have to do this. Now, once you reach age 59 and a half, I'm smiling now because I have so much fun at this part of the presentation. You're eligible for what I refer to as the tax-reducing plan. This is very simple. Get out. Get out. The day you turn 59 and a half is the day you should call your broker and say, you know what, I quit playing this game. Take the taxes, withhold it, and put it in an account now that's not going to pay taxes again. But I want out of this plan. Now, it's here where wealthy people look at me like I'm a fool. I'm not going to do this, Tom. I understand, but let me just ask you, how's your mortgage payment doing? What do you think the answer is? I don't have a mortgage payment. And why do you think they tell you they don't have a mortgage payment? They hate debt. I just about chuckle. Let's analyze what you are voluntarily choosing to do. Remember, this is your choice. Today, you can borrow from the bank in a 30-year contract that's guaranteed to never change. Guaranteed to never change for 30 years. You'll know what the rate is, which, by the way, is probably the lowest historically that'll be in your lifetime. Where the IRS will give you back roughly a third of the cost of borrowing that. You paid that off. Yet you continue to fund an account you can't calculate what you owe. Does that make sense? You paid off the wrong person. If you're truly debt averse, listen, every time Congress goes into session, they can change the terms of your pension plan. And on January 1st of 2013, they're going to change the terms of your pension plan. Why? Because you're in it. And you know why? Because they can. Now, again, I'm all for saving money, but there's one other thing I want to talk about. Thanks, Gene. Who remembers March 9th, 2009? We got plenty of time. Worst day of the stock market, right? Sorry about that. Nancy Pelosi goes on television in February of that year. I don't know if you remember. This was heartbreaking. And she went on television and she said, elderly of this country, we feel your pain. It was that previous administration that's destroyed your retirement plans. We're going to waive RMD this year. See, here's what was actually happening. Somebody tapped Nancy on the shoulder in February of that year and said, Nancy, Mom's shares of stock were $100 2 years ago. If you allow her to take out her share of stock at 30, we're only going to get revenue on 30. Let's go on TV and cry. And let's go on TV and break the law, change the law once. And if you give into this hope and change, you know what's going to happen? Your retirement plans are going to come back. You know what? I've given this presentation now 277 times in the last 18 months. I have met one person who in the month of March, not March 9th, but who in the month of March got out. Not switched to cash. That was the worst thing you could have done. I'm talking about got out. Everybody else, you know what we did? We stayed. You know what we should have done in hindsight? Gotten out. See, because the taxes weren't due, or the penalty even, if you weren't 59 and a half for 13 months. In hindsight, we would have made enough money in the stock market's S&P index fund to pay all the taxes and all the penalties and still netted more money than what we had on March 9th. But that's not what we did. We stayed put. Maybe even contributed more. Now, what I want to do is I want to talk to you about cash flow. Now, you'll have to bear with me here. I think I can see a little bit of... Okay, so if I hit the erase button, goodbye. All right, I want to talk to you now about cash flow. I want to age everybody to the age of 62. Sometimes that's going forward, sometimes that's going backwards, I understand. But at the age of 62, meaning you're going to be eligible for some form of Social Security, and you've retired. I don't want to play the game for every dollar you earn, you lose $2 in benefits. Nope, 62, you quit. And you have amassed your wealth, sorry about that, in 3 buckets. How much money we have in each of these 3 buckets will usually be interpreted by somebody's interpretation of 47,000 pages of tax code. And it's usually going to be incentivized by the IRS to either make a contribution or leave it alone. But the first bucket is qualified money. In our business, we call that pre-tax. That's every one of those little alphabet soups I was sharing with you earlier. The second bucket is non-qualified money. Non-qualified money in our business we refer to as after-tax. And after-tax means you pay with after-tax monies, you acquire what you want to acquire, and then with the disposition of that asset, you square up with the IRS at that time. And this third bucket is called life insurance. And I'm looking them in the eyeballs when I'm writing this because I want to read their body language. And then I say this. I say, you know, I don't know how you feel about how life insurance can be used as a wealth distribution vehicle during your lifetime. I simply want to share with you how the IRS is going to look at this. Okay? And they're probably going, huh? And by the way, this is life insurance on steroids. 33 years in the business, and it was 29 before I saw this. I can't imagine clients. Now, I want to put $1 million in each of these buckets because I want to do a side-by-side comparison. By the way, we don't have time for the dialogue about the wealth accumulation part, but you haven't used taxes to get to the million, and you got to pay more than $1 million to get to the million. Stop it. These are your objections. They're not your clients. We are our own worst enemy. You have $1 million in each plan, and I want to pull out 8%. Now notice, I'm not earning 8%. Our compliance officer would be happy I said that. I want to withdraw 8. And I'm using $80,000 for a reason. It's a Social Security calculation. But I'm pulling out how much from each bucket? 80,000, right? 80, 80, 80. But we haven't paid the IRS yet, so let's go through this little miserable exercise. Here I can stroke a check for as much as $28,000 and I spend $52,000. If I pull $80,000 out of a qualified retirement plan, 85% of the Social Security income that you told would be tax-free is going to be taxable. You, according to the IRS, blew it. You were too successful. Wow. Wow. There are 3 ways to compute the taxes due in the distribution of a non-qualified mutual fund, for example. There's LIFO, average price, and actual price of the share. The IRS uses LIFO, last in, first out. It's completely wrong, but they force you to prove them wrong. We use the actual price of the share method, meaning I have to keep track of my cost basis. So let's assume, for purposes of my conversation here, that half is my money and the other half is unrealized gain. And on the day that I pull out 80, it's exactly half and half. Well, the code is very specific on this. Very simple, too. The first half's free. It's classified as return of principal, and the tax due on it is nothing. You know what amazes me? If you've ever heard this before, a 1040 is a tax form where you have to put income subject to tax. It is not a cash flow form. What? It is not taxing your cash flow, it's taxing income that's subject to tax. $40,000 of this is free. The other $40,000, if held for at least 13 months or longer, are subject to the most favorable tax in our tax code. Long-term capital gain, currently 15%, and 15% of $40,000 is 6. Here I get to spend $74,000. Now, if I pull $40,000 out of an investment that's taxable, up to 50% of my Social Security is going to be taxed. Yes, sorta, semi, quasi, blew it. It's here when I look them in the eyeballs, because I'm already drawing the circle. How much is taxable if I take that out of my life insurance? 0. As a matter of fact, 100% of my Social Security is tax-free, and I qualify for food stamps and government cheese. Now, it's here where I turn the piece of paper around and I ask them this question. Now that you know how income taxes will affect the distribution of your wealth while you are alive, in which of these 3 buckets does it make sense to have very little income? And which of these 3 buckets does it make sense to have a lot of income? And obviously they say the IRA is not good in this example, and the life insurance makes a lot of sense. And it's here where I pull away the life insurance and say, you can't have it like that. And they look at me like, what? You told me I could have? Nope, you can't do this. I'm going to give you the 5-minute lesson on life insurance. It takes 7 minutes, and then we're done. I'm going to give you an example. Okay. Discard note, no. Apologize for this. I'm looking at half a screen. The other half is blank, and I have no idea. Somebody said I could sue Delta. Is that true? No, but I understand that you can file a claim. I think I'm going to buy the ticket. Good. I only paid $300 for the computer. Okay. The 5-minute lesson on life insurance. This takes 7 minutes. Good, we're on good time. Now let's go back to the conversation we were having earlier about needs versus wants. Because you see, I don't know how much life insurance you need, but I'm going to share with you how much you may want. And if you really analyze that statement and listen to what you're saying, you are enabling someone to do things for their reasons and not yours. See, I have no idea what you need. We've got computer programs, we can do some hypotheticals, and we can come up with a number, but those pretty much guarantee the minimum. I mean, do you want your family to be at the minimum? But I'm going to share with you how much you may want. So let's assume we do a financial needs analysis, a retirement plan, estate plan, a financial plan, call it what you wish, and you need $1 million of life insurance. Now remember, you need it, you don't want it. And here's the difference. If I told everybody in this room, I will pay for the rest of your life, all the life insurance you want, just send me the bill, I'll pay for it. How much would you put me on the hook for? Yeah, but how much do you want? All of it. How much do you need? Oh, now I got to pay for it. Here, you know why I'm so passionate about what I'm doing? According to LIMRA statistics, 76% of the people that work for this establishment will buy life insurance from you today. Today, if you simply showed them how to pay for it. Simply showed them how to pay for it. That's all this whole presentation does, is find tens, if not hundreds of thousands of dollars. And I'll show you that in a second. $1 million policy. Now, you need to be aware there's a minimum and a maximum you can spend in that contract. Who dictates the minimum premium? There's an actuary. Sits in a room with no windows on, beanie cap with a propeller, and an abacus. And they calculate to the dime what's the least amount of money they can charge in the form of premium, put aside some in the event of mortality, but much more important, put aside some profit, because only 2% of term insurance has ever been paid out in claims. This is the most profitable form of insurance, by the way, and that's all I say. There's a maximum you can put into life insurance. Who determines that? Louder? Shame on you. Shame on you. You know that. Your clients don't. You've been sitting on one of the biggest things you possibly could be given. You have a license to steal, and you've never shared this with your clients. If you're 62 years old, the minimum you can put into term insurance, let's say, is $2,500. And according to the IRS, the maximum you can put in is $74,386.21. And by the way, that's not the exact amount. That's just how stupid the tax code is. Based on three things: age, face amount, whether you're a male or a female. All insurance companies use the same code. That's the most you can put in. Now, you're a smart person. If you need $1 million of coverage and you could write a check for $2,500 and the need goes away, who wants? Are you listening to where I'm placing the need and the want? Who wants to put in 74? Who would want to do that? Stupid people, dumb people, people who don't know about how to do things. Really? Well, the fact that the government limits how much you can put into life insurance means two things. It must be good, and it must be good specifically as it relates to taxes. I'm going to go back to 1985. I'm going to pick on Snoopy. And by the way, we all did it. I'm just picking on Snoopy because it happened to be Snoopy's ad that was held up in Congress. And by the way, I've Googled that photograph. I cannot find it. Please, if anybody can, where Bob Packwood is holding up Met's ad, please, I got to have a copy of that. In 1985, Metropolitan took out a full-page ad in the Wall Street Journal, and we all did. And this is what it said: give us $100,000 once, and we're going to give you income tax-free for the rest of your life. That's right, never pay a dime worth of taxes for the rest of your life. $8,000 a year. And because it's life insurance, there's also a tax-free death benefit. That's right. So let's summarize here, people. One contribution, no taxes ever. Who else reads the Wall Street Journal besides potential clients? Senator Bob Packwood held up Met's ad in Congress, held it up, and said, ladies and gentlemen, this has nothing to do with widows and orphans. This has nothing to do with the sanctity of the cash value buildup inside a life insurance policy. This is an investment, and we're going to tax it as such. Now, I don't know if you remember, but in 1985, there was no internet. In 1985, Federal Express was a fledgling company. Senators back then weighed their mail. Weighed it. So if they were proposing legislation that wasn't popular, they would send their grunts out, get their mail in a bag, set it on scales, and if it was tons, they probably realized it wasn't very popular back home and they wouldn't vote on it. Vigorous debate ensued, and in July of 1986, the code changed. Now, I use this time here for a reason. That's the last time they have affected life insurance. July of 1986. How many years ago was that? Wow. I could have had my career on this. I've only been doing this for 4 years. Wow. Tamara and Deffer came out of that. The 401k plan was born and the IRA for everybody. But let's go back to the needs versus wants question. If you truly need it and you can get the minimum done and it's gone, who wants to put in 74? Ladies and gentlemen, only 4% of the people that are buying life insurance today are buying it under that format. 4. When you ask somebody who just bought a Rolls Royce why they bought a Rolls Royce, it's because they can. They can. When you ask a millionaire why they bought the 150-foot yacht, they can. And you can't. And they almost say it smirkingly. I can and you can't. But that's the psychological thought process of super wealthy people. They do it because it's a very exclusive club. Ladies and gentlemen, I'm asking you to join the ranks of 4% of the people in this country that are buying life insurance. 4. And here's how I want you to buy the life insurance. Before, this is how we would do it. I want that much death benefit, and I'll give you a quarter. That's all I want to give you because I know the rate of return is horrible. So, and you better do well on this quarter. I'm going to complain at all my friends at all the cocktail parties about how bad you treat people. That's it. Here's what I want you to consider. There's 36 things we do wrong every single day. I want to capture 7 of them. 6 at the most. Take that wealth to the insurance company and say, I found $78,342. Buy for me the smallest face amount you can. Why? Here's why. Tax-free death benefit. Tax-free accumulation. Tax-free distribution. Tax-free transfer. There is no 1099. This is not subject to a penalty prior to the 59.5 rule. This money is not subject to creditors. Ask OJ. You can use this money as collateral. This is a very competitive rate of return. We use guaranteed cash value. We use a 10-pay life. This money does not offset Social Security. And when you think about that, you talk to wealthy people and got a portfolio of muni bonds. Does muni bond income affect Social Security? Do this. Sure does. Sure does. Not subject to Obamacare, federal, state, local tax. And the number one reason why I like this as much as I do, I can put in as much money as I want to. I'm not limited by code. How many people have we talked to, ladies and gentlemen, that have said, I've maxed my 401k plan, I can't put money anywhere else? We've had those conversations. Well, if I can put an account that's exempt from tax, if I didn't call this life insurance, if I called this the super duper whammy mutual fund, you'd buy it. All right, I've got 10 minutes. $110,000 income. Maximizing one 401k plan. Standard debt, 2 automobile payments. And they're on the 15-year accelerated pay off their house plan. By the way, this was an actual case. When I went on the road doing this for my clients first, this guy stood in my wedding. He made 80. His wife made 112. They were making good money. They had no money left at the end of the month. He had 5 toy payments. A brand new Denali, a brand new Silverado, a brand new boat, a boat he's still paying on, he's trying to sell, in his daughter's car. He was 7 years into a 15-year mortgage. And this was back when you could refinance. We refinanced his house, paid off all of his installment debt. We found $72,000 freed up money. who I am convinced, had you seen him the week before and offered him to buy term insurance for $400 a year, he would have told you he couldn't afford it. We went through this presentation and he said, Tom, this is awesome. $72,000. Wow. Can I think about this for a while? I said, absolutely, Rick. Take your time. 3 days later, he calls me. He says, Tom, Cindy and I love this idea, but just we don't know anybody who's putting in $72,000 a year for life insurance. And truth be known, at that time, I didn't know anybody either, and I was kind of hoping they'd be the first. He says, can we do half? Yes, Rick, you can do half. Yes, you can do half. The 6 places that we find premium dollars. Number 1, non-matched 401k. Now, I have to be frank with you here because Bob's busy. Just a joke. You have to understand what the definition of match is. If some matches, and you know we've heard them all, I put in 10, the company puts in 1. That's not a match. That's an insult. But I also have talked to people that if I put in 6, the company puts in 6. That's a match. Voluntary excess contributions are questionable. Usually at this point they're saying, why would I want to feed a pig? I can't even define what I'm going to owe. So the discretionary, I don't want to contribute. So I'll take that money. That was $13,500. The next thing we do was a 72T. Oh, he had $250,000 in rollover money. And at that time, the rate was 5%. So we took $12,500 a year out of that. The next is debt. Oh, I'm sorry. Thank you. You know, you are my eyeballs out there since my computer is gonded. So where are we at so far? 26? The $1,000 term premium, we don't have to pay anymore because this buys a lot of death benefit. That's $1,000. Now, the debt is what, with Rick, the debt, we came up with about $40,000, which we're not going to use here because on a family of 110, and we all know families of 110, where we can easily find somebody maximizing at least 401k plan. So even if I non-match 401k plan, 72T, now if you're 60 years old, 59 and a half, games, a whole new set of rules. I can redeem the account over a period of time to 0. That's called the accelerated payout plan. So for people who are 60, you can redeem the IRA over a structured period of years, pay the taxes, and put the money over in the life insurance and create this tax-free account. And then how much money they have in that center bucket. If somebody has $100,000 in Charlie Schwab's account, but they're getting 4% on their money, can I have 2 of it? Instead of adding it back up, isn't 0% better than 15? And here's what I want you to write down. This is how you're going to get the appointment with the client that you right now know could fit this bill. I just heard something that blew me away at MDRT this year. I immediately thought of you, and I want your opinion on something. Would you give me 30 minutes of your time? Now listen, if you've ever had an appointment where the guy's just not responding, he's not receptive, ask him, can I have your opinion on something? Oh, I'll tell you why your association sucks, why you stink. Absolutely, come on down. Go see him. Go through some of these ideas. We've got a couple minutes. We've got 6 minutes left for questions. So we don't have to wait until I'm outside. Does anybody want to? Yes, if you'll. Gene's going to moderate. Now, do you want to thank Gene? Yay!
It's my own self-interest, too. Okay, please come to the mics in the center. We have about 6 minutes for questions, so fire away, right here.
Yeah, real quick, you just said you were using a 10-pay, and I was wondering how you do the 72T if they're not going to be, if you do a 72T on them.
On a 40-year-old?
How you do a 10-year. I mean, what do you do with the premium if they continue the 72Ts and they're 45?
The product that we use is a life at 65, issued up to age 70. What? It's a life at 65, meaning the premiums stop at the age of 65, but we'll issue it to age 70, at which point from 55 and beyond, it's a 10-pay life. Okay? and we're going to try and get to age 75.
In the back, please.
Yeah, when you do 72T, is there some rule of thumb of how many years you try to spread it out? How quickly you try to get the money out?
The annuitization, amortization, or life expectancy,
Right.
the one that gives you the biggest chunk of money is the annuitization rate, and that you just go to us.gov and punch in the numbers and it'll tell you.
And then after they've hit the 5 years or 59 and a half, you take as much as you can?
At 59 and a half, I've already sold the idea that you're 55 today, we'll 72T it, and by the time you're 59 and a half, we're going to buy another one and take the balance. Now I got 2 contracts sold.
Thanks.
Yes, ma'am.
Do you have this in print, and do you have it on the MDRT website?
No, ma'am, this is not in print right now. This is in my head. I am trying to work jointly around the country with agents. So
Can I rent your head?
yes, you may. Here, take my card. Absolutely. You want to wallpaper your office? I'll give you 1,000.
In the back, please.
Tom, thank you. How do you overcome the low cash value in the first couple of years of a permanent policy? Because a lot of times, obviously, we all have responses to that. I'm curious to see how you do that.
The policy that we use, I'm using an example of age 55. The first year's premium grows by 9.9%. Second year, it grows by 93%. In the third year, it's 103. So what early problems? And remember, I'm overfunding on purpose. So, and remember, CLU 101, cash value is a function of premium. And if you're 40 years old and you're buying a 30-year payment, your cash value is slow. Cram it into 10. The cash value is huge. Huge.
Thank you.
You bet.
Tom, my name is Rao Garuda, and I qualified for top of the table 18 consecutive years.
Congratulations.
Thank you.
Top of the table 18 consecutive years. Wow.
And I met Bob Castiglione about 25 years ago. Part of the reason I consistently qualify for top of the table is this idea. I just wanted to
thank you.
To really acknowledge what a wonderful job you're doing.
Thank you.
Thank you very much.
I appreciate it. Thank you. Yes, sir.
Tom, I appreciate what you shared. I was just trying to think of something, maybe if you ever have this objection or whatever, but once you reach age 59 and a half, you're saying really you should completely cash out of your 401k or IRA because of who knows what the future tax liability is going to be when fairly low tax. Is that what you're saying, and put it in a life insurance vehicle?
I have a joke at that point because
Okay.
I'm usually speaking to wealthy people and they look at me like I'm a fool. And I make the point to say get out of the plan because they tell me so adamantly I'm not going to do this because I hate debt, bringing in the mortgage. And then I show them really what's happening to their IRA. I do not surrender the IRA at 59 and a half in full. I take it out over a period of time. If you understand TAMRA, you have to make 7 annual equal payments into life insurance for it to be life insurance.
Right.
So the minimum I would do is 7 years.
What about the Roth IRA now? You can, no matter how wealthy you are, you can completely take all your money out of your IRA, convert it to a Roth as long as you pay the taxes on it. Where does
Are
any
you
of it
aware?
go in a Roth?
I'm sorry, I didn't mean to interrupt. Finish.
No, I was going to say, does any of it go in a Roth, or do you put 100% in life insurance, or do you diversify and not put all your eggs in one basket, or how do you handle something like that?
I'm going to make 2 comments on that, and one is an Arsenio Hall moment. First, are you aware that Roth language is written after the Internal Revenue Code's definition of life insurance? I mean, it's almost verbatim language on the Roth versus life insurance, except you make one contribution to a Roth, your death benefit is whatever the market has affected the value.
Right.
You make one contribution to a life insurance policy, and depending upon age, it could be 20, 50, 100 times the contribution
A lot
basis.
more leverage.
Right.
Yeah.
And here's the Arsenio Hall deal. Why does the IRS demand? They don't ask, and they don't even use the word please. They demand a 1099 end-of-the-year valuation statement on an account that's never to be taxed. Don't answer that. There isn't one. It's just one of those. Have you seen the one-page calculation that it takes for you to determine the income that is subject to Social Security tax? It isn't a chart and says, well, if you make 12 grand, you have to. No, it's a one-page calculation. Put in, take away, add to, then take 1/3, multiply. I can see them doing that. Remember, Nancy Pelosi at the push of a button, now John Boehner at the push of a button, can tell you the exact value of the Roth IRA accounts in the system. Why? They know. Right. And remember, this administration is all about everybody. So if the average is $15,000 in a Roth account, you smart, intelligent man, have $1.2 million in there. You know, we just can't let that happen. We can't let you get away with that. So how about the income equivalent to the first 15 is free? Because after all, we told you it'd be free. I see that happening more than I do one or the other. Right. But I would rather contribute wealth in an account that is not subject to the IRS scrutiny. Life insurance companies don't have to notify the Internal Revenue of any transaction unless you MEC it.
Right.
Other than that, you can use it what you wish.
Okay, we have time for one more question right here, please.
With NAIFA's recognition and acknowledgement that the attack of cash value billable life insurance likely sometime in our future is going to have a different look and feel than it does today, I would suggest that you may be back in a similar situation as the conversation you just had about the rules regarding Roth. Your comments.
Say that again. I was thinking of something else.
You know, there's a lot of argument about the scrutiny that may happen and the things that may happen to Roth IRA in terms of the promise that you put out there and it's never going to be taxed.
Right.
And yet we combat that then with the language and the information that you just shared about the risk of the future of the tax issue with regard to Roth. I'm suggesting that we may be faced with the same similar problem with cash value billable life insurance with the current attack. Your thoughts?
Great question. I have found out recently that there's some very powerful people in Washington that are doing this. And trust me, they're not putting in 10,000. Which would lead me to believe, remember how self-serving those people can be in Congress. If they're contributing tens, hundreds of thousands of dollars, is now there a better incentive for them to grandfather again? Remember, they grandfathered in 1985 or 1986. I came across a single premium whole life policy last month. The guy never took a dime out of it, but he's got single premium whole life. So if they change the tax code, and I'm sure NAIFA wants to do this, grandfathered again. Let's play by the rules and let's move forward with a new set of stuff, but leave alone that's in place.
Okay, thank you, Tom. We're out of time, guys. He'll be out in the hall in the back afterwards. Let's give him a hand.
That concludes this program. For additional information on the $1 Million Roundtable products and services, contact the Marketing and Communications Department at 847-692-6378 or visit the web at www.mdrtpowercenter.org.